Earnings did beat during the second quarter. The movie theater chain swung to a profit and its revenue grew 15% from a year ago. Looking ahead to the current quarter, CEO Adam Aron stating that, quote, the third quarter of 2023 is off to an explosive start with Barbie, Oppenheimer, and others combining to cause July to become the highest monthly revenue in AMC's storied 103-year history. So certainly July very strong from the box office for AMC. When it comes to the numbers that we just got for the most recent quarter, attendance numbers back up to where they were pre-pandemic, the highest quarterly attendance that we've seen since the fourth quarter of 2019.
Yeah, and it was a surprise profit, actually. And the stock initially popped on the news before coming back down off of that pop. And, you know, they released before the bell today. We were originally expecting them later, so they did have strong performance from Super Mario Brothers in the quarter of the earnings that were just released. That was the first billion-dollar movie of the year. Barbie has now become a billion-dollar bet, paying off. But then some of the problem going forward is how much these strikes could impact the film landscape in the future. So that could certainly be one of the challenges coming into play for AMC. Again, it was a beat, net income $8.6 million or a share. Better than a loss, but, not enough to please Wall Street. And we know this is a meme stock, so it kind of fluctuates in response. Another stock we're watching, shares of Beyond Meat headed to the beyond. That stock finished the day sharply lower, down double digits. We're looking at extended hours, but it was down double digits for the day. This after the plant-based meat company reported weaker than expected earnings. It cut its full year revenue guidance and said it no longer believes it will reach profitability this year. You're looking at the chart where it was down 14% for the day. Beyond Meat now sees full year revenue in a range of $360 million to $375 million. It previously seen revenue in a range of $375 million to $415 million. So it just shows that demand isn't there for the alternative meat. Fake meat.
Demand is not there, Diane, and we were looking at the biggest drop that we've seen since 2020. It fell as much as 21% earlier in today's trading action. And this is a company that struggled now for quite some time, really trying to get investors back on board with their vision. And they've really struggled to expand their share within the industry. There was some reaction to these results. Piper Sandler saying that they remain bullish on the stock, given some of the margins here that continue to be pressured. Also, sales growth and momentum has yet to materialize. There was maybe some improvement in the second half, which would be consistent with Piper Sandler's guidance, but still many of the headwinds, the risks there outweighing some of the progress that we could see in the second half of the year for Beyond Meat.
Right, and it's certainly a lot of the what we're seeing with regard to the stock price reflected in the future outlook being cut. It reduced it to between $360 to $380 million for the year. That's down from between 9 to 14% from last year. It just shows that the question of will they be able to continue to perform as well as they did a few years ago, it's not there.
Yeah, exactly. Yeah. the sentiment around the stock has certainly changed since then. All right, let's take a look at DraftKings closing the day higher. Got an upgrade from Truist, closing up just about 0.25%. But analyst Barry Jonas boosting his rating on the stock to a buy from hold, also raising his price target to $44 a share, citing a clear path to significant and sustainable profitability as the company narrows the gap between themselves and FanDuel, which is by far the leader within the category. But Truist in this note saying, quote, the training wheels are off. DraftKings topped their profit expectations in the second quarter earnings report that came out last week. So they are showing some progress on that front. And Truist, very bullish in terms of the catalyst here going forward, able to they at least see a pathway here for DraftKings to narrow FanDuel's lead within this sector, and they see growth of just about $13 a share here in the near term.
Yeah, they're not the only one. It follows on the heels of upgrades from JMP Securities and Wells Fargo. Wells Fargo upgraded DraftKings to overweight from equal weight. They raised their price target to $37. $37. Their rationale was just faster, steeper growth of EBITDA. You also had JMP Securities. They raised their price target to $39, so even higher than Wells Fargo. So they all three of these guys seeing future growth within this, also seeing positive EBITDA there for DraftKings. So it certainly has some wind under its wings there for DraftKings as it continues to grow in that space.